Welcome back to Morning Trade Live. WTI is soft again today as crude oil is pulled back from touching almost 85 bucks. Joining us, Vikas Dwivedi, energy strategist at Macquarie Group. Vikas, welcome back to the show. Thanks for being with us this morning.
Yeah, thanks for having me back.
So I know you've got kind of a structural bearish view going forward on crude. Take me kind of through the last month, though, first, as we did get this run up June into July. Basically stopped short of 85 bucks. What happened there?
Yeah, we think about three things that happened. The Middle East tensions ramped up, and that created more risk premium in oil price. Two, the market was actually tight, physically tighter markets as a result of rapidly rising refining runs. And production growth, which we think is still going to be very big later in the year, hasn't really started to click upward yet. And then the hurricane sort of was the kind of the last leg of the upside. And now we're giving it back. And I think the Middle East risk premium and the hurricane risk premium are largely exiting price. And that's why we've been trading off. But also the physical tightness in the market is still persisting. It's a seasonal item, but I don't think it's carrying quite as much weight because now it's sort of a static seasonal item. It's not a new part of the day-to-day.
The hurricane, let's knock that one out real quick. Is that just because we kind of know where it's going to hit? It's not going to disrupt anything major? Or is there still potential outcomes there that could be extreme, or are we kind of like eliminating the extreme risk of that from a weather event?
Yeah, I wouldn't maybe say we've eliminated it, but it's definitely gone down. And, to hit oil production from a hurricane, it would take an unusual pattern that would have to kind of weave and bob through a lot of different production lanes in the Gulf of Mexico. Less likely. Now, you can get a hit to the refining system, which is much more concentrated along the coast. And that's actually going to knock out crude demand, right? When refineries aren't running, they're not consuming crude. And it'll knock out, in a severe case, demand for petroleum. You just have a coastline that's stranded for a period of days or weeks. So oddly, it could be more fundamentally bearish. It's a different way to think about it than I think people and the trading community has thought about it for a long time.
The move, I like that. The move on the refiners too. We've been hearing from some of the energy drillers, some of the major producers, that their crack spreads have gotten a little bit unmanageable and they've got margin problems. I'm curious, kind of from the perspective of refining, if you think that could worsen or not from here.
Yeah, it could. I think mean reversion for refining margins is a tough thing. It's tempting. You want to say, look at this chart. It's way high. It's way low. This is a good entry, and often those are traps. And here, what that means is refining margins aren't great, and they look attractive as a long on the charts. We still think they could get worse, maybe to the heart of your question, because there is a big ramp up in refining runs, and demand is not terrible, but it's not good either. It's sort of like okay, but it's not. The demand growth needs to be trending towards about 1.5 million barrels a day or higher globally, and it's probably closer to 1 million. So, and 1 million is not terrible, but it's just not enough. And what we think is a little bit worrisome for oil prices, the big production growth is still to come. The OPEC barrels are still to come by design and through non-compliance. And then U.S. production growth will really turn upwards, we think, in October, November.
What does a bear case for crude get you to, Vikas? Because it does seem like whenever the U.S. Production really ramps up, there's like a floor where the Saudis and OPEC will start to cut. It's like, is there at least, is this like a range-bound bear case? I mean, or do you think we could really be plumbing like new lows relative to the past year?
Yeah, we think you're going to get to new lows. By the second quarter of
Wow.
2025, we're expecting $64 Brent.
Oh, wow.
And that's from an accumulation of surpluses. So it's, a lot like boxing. It's good. The market will have to take a lot of body shots before it gets knocked out. And surpluses that just accumulate over the next few quarters will probably be what gets that price down into the mid 60s. Now, it's a great question, though. Will OPEC sit idly by and let that happen? They haven't, and they've been way better and more nimble about cutting when they need to. And that could create a floor before it gets to our price targets. We have thought about that. We just think, though, that with 5 million barrels offline right now and Saudi doing most of the work on the cuts, you know, finding another million to cut if needed might be way tougher than it has been the last couple of years, right?
So at this point, the economic situation doesn't seem to factor in too much. You're looking at it like pure supply overhang. What if the economy then were to slow down here in the U.S.? Like, would we be talking like 5 handle in WTI?
Probably not. But I mean, look, when you're down at mid 60s, and overshoot into the 5 handle area is doable. That's not a big stretch. And that would be more a function of where the trading capital flows go. There's so much trend following money that would love that trend, right? If it's falling from the mid 80s to the mid 60s, they will be adding larger short positions along the way, and that could carry it, below 60 in that situation.
Okay, love it. Vikas, thanks for the analysis. A good I guess, contrarian take, thinking down to the lows with WTI over the last month kind of firming up. So keeping us honest in our analysis. Good stuff. Appreciate your time.
All right, thanks.
You got it. Vikas Dwivedi, Global Energy Strategist at Macquarie Group.